Welcome, everyone. I'm thrilled to have you here today. In this session, we are going to explore how modern corporate treasuries measure success. We will dive deep into defining key performance indicators, or KPIs, and how these metrics translate into strategic deliverables that elevate the entire organization. Let's get started. Let's begin by defining what we mean by KPIs in the context of corporate treasury. Traditionally, Treasury was seen merely as an execution function processing payments and managing bank accounts. Today, it is a strategic powerhouse. KPIs are the quantifiable metrics we use to evaluate our success in this elevated role. Why do we need them? Because what gets measured gets managed. We need a balanced scorecard that captures both hard financial numbers and operational efficiencies to prove our strategic value to the CFO and the board. How do we do this? We align our treasury targets directly with the company's broader business objectives, ensuring that every dollar optimized or risk mitigated serves the enterprise's growth. As we dive deeper, you'll see that effective KPIs don't just look at cash balances, they encompass the entire financial supply chain. Take a look at this flowchart. It illustrates the top-down approach to defining our metrics. We start at the very top with corporate strategy, which trickles down into specific treasury objectives. These objectives generally fall into three buckets: liquidity management, risk management, and operational efficiency. Each of these buckets requires its own specific set of KPIs: financial, project, and process metrics. When we measure and hit these KPIs successfully, they converge at the bottom to produce our ultimate goal, strategic deliverables. This visual perfectly maps out how daily treasury tasks roll up into massive strategic value. Now, let's break down the basics of what we are actually measuring. Treasury metrics generally fall into four core categories. First, we have financial performance metrics. These are your hard numbers, things like operating cash flow, yield on investments, or your weighted average cost of capital. Second, we look at activity or project-based metrics. If you recently implemented a new treasury management system or outsourced a process, how much did you save? Third, we have process-based metrics. These are micro-level indicators like the turnaround time for foreign exchange settlements or the number of days an invoice sits in float. Finally, and often overlooked, is human feedback. Treasury is a service center for the rest of the business. Surveying internal business units on Treasury's responsiveness is a critical, albeit subjective, KPI that rounds out our scorecard. This diagram breaks out the four core categories of our treasury metrics horizontally. From the central node of treasury metrics, we branch out into financial, activity/project, process level, and human feedback. Notice the specific examples attached to each. Financial leads to cost of capital, indicating our funding efficiency. Activity leads to hedging savings, showing the ROI of our risk management strategies. Process tracks turnaround time, proving our operational speed. And human feedback captures internal satisfaction, which is vital for our role as internal advisors. You need a mix of all four to truly assess your treasury's health. Understanding how to measure is just as important as knowing what to measure. In treasury, we utilize several units of measurement to quantify our KPIs. The most obvious is dollars or value. But we don't just look at vanilla or nominal numbers. We often look at discounted cash flows or tax-adjusted and risk-adjusted values to understand true economic impact. Next, we use market rates, measuring our funding costs against benchmarks like SOFR or LIBOR, or tracking our achieved FX rates against budgeted rates. Time is another massive currency in treasury. We measure cycle times, such as how long it takes to convert a sale into cash. Finally, we look at sheer numbers and volume. How many transactions were processed straight through without manual intervention? Measuring these throughput volumes tells us how scalable our automated processes really are. This mind map visualizes our toolkit for measurement. At the center, we have our units of measure. Branching out, you see value, market rates, time, and volume. Under value, I've highlighted discounted cash flows and risk-adjusted assets, reminding us that absolute dollar amounts rarely tell the whole story in finance. Under time, we have cycle times, which are critical for working capital. And under volume, we have straight-through processing, or STP, transaction counts. By applying the right unit of measurement to the right category of metric, we ensure our KPIs are accurate, comparable, and deeply meaningful to executive leadership. A KPI is just a number until you compare it to a benchmark. Establishing when and how we set these benchmarks is crucial for objective evaluation. We primarily use two types of benchmarks, internal and external. Internally, we look at historical numbers. Are we clearing payments faster today than we did Q1 of last year? We also compare against our own targets, budgets, and forecasts. If our cash flow forecast predicted 10 million in liquidity and we only have 8, our forecast accuracy KPI takes a hit. Externally, we benchmark against industry peers. We leverage banking surveys, credit rating agency metrics, and industry standards to see how our cost of capital stacks up against our competitors. These benchmarks must be cemented at the start of the fiscal year and codified in your Treasury policy to ensure objective, unbiased evaluation. Here we see the life cycle of an evaluation. You start on the left with your raw KPI result. That result passes into the decision gateway. What is the benchmark type? We route it through either internal channels comparing it to historical data or budgeted targets or external channels, analyzing it against peer comparisons and credit ratings. All of these paths converge at the final stage, performance evaluation. This structured comparison prevents subjective grading. It ensures that when we report to the CFO, we aren't just saying we did well, we are saying we outperformed our historical average by 15% and beat the industry peer benchmark by 50 basis points. Now we dive into the deep end, strategic deliverables. This is where our KPIs translate into actual corporate power. When we hit our metrics, what does the business actually get? First, we lower the cost of funding. By hitting debt servicing KPIs and maintaining strong credit ratings, we secure cheaper capital. Second, we provide liquidity. We ensure the business has the exact cash, in the exact currency, at the exact location required to operate without friction. Third, we enhance operating cash flows. By hitting our working capital targets, we free up trapped cash and reduce reliance on external debt. Finally, we increase stability. By executing our hedging KPIs perfectly, we insulate the company's balance sheet from wild swings in foreign exchange or interest rates. These 4 pillars are the ultimate strategic deliverables of a world-class treasury. This diagram captures the essence of treasury value creation. At the top, we have our achieved KP as the foundational work. Notice how they cascade down into our 4 strategic pillars: lowering funding costs, ensuring liquidity, enhancing cash flows, and increasing stability. These aren't just isolated benefits. Look at how the arrows all funnel directly into the core objective at the bottom: enterprise value creation. This is the visual proof that corporate treasury is no longer just a back-office processing hub. It is a primary driver of shareholder wealth and corporate resilience. It's vital to acknowledge the real-world caveats in measuring our performance. We don't operate in a vacuum. First, consider market volatility. A massive, unforeseen spike in interest rates or a geopolitical currency crash is beyond our control. If our hedging cost KPI looks bad because of a black swan event, the evaluation must be contextualized. Second is indirect governance. Treasury doesn't control sales or procurement. If the sales team provides a highly inaccurate revenue forecast, Treasury's FX hedges will be misaligned. We get penalized for another department's error. The solution: we must properly weight our metrics to reflect what Treasury actually controls. Furthermore, we must evaluate restorative actions. If a crisis hits, the KPI shouldn't just be did we miss the budget, but rather how swiftly and effectively did Treasury restore liquidity. Context is everything. Let's trace the reality of a KPI result on this flowchart. Your Treasury KPI result goes into the middle node, where it meets external influences. It is impacted by market volatility, other department forecasts, and geopolitical events. Because of these interferences, the raw number cannot go straight to the board. It must flow into an adjusted performance evaluation. Ultimately, this leads us to the bottom node: focus on restorative action. This diagram teaches us that an effective scorecard doesn't blindly punish the Treasury team for external shocks. It evaluates how skillfully the team navigated through the storm. Let's look at a real-time use case. Imagine your CFO tasks you with reducing external borrowing costs. The best way to do this is to optimize internal working capital by tracking the cash conversion cycle, or CCC. The CCC is a powerful KPI that measures how many days it takes to convert inventory investments into cash. The formula is simple: days sales outstanding, DSO, plus days inventory outstanding, DIO, minus days payable outstanding, DPO. If Treasury can work with sales to collect cash 5 days faster and work with procurement to pay suppliers 5 days slower, you reduce your CCC by 10 days. On a billion-dollar balance sheet, that frees up massive liquidity instantly. Let's look at a simple Python snippet you might use in your Treasury dashboard to calculate this. Def calculates CCC, DSO, DIO, TPO. Return, DSO plus DIO, TPO. By tracking this dynamically, Treasury directly lowers the cost of capital. This diagram maps out the physical and financial flow of the cash conversion cycle. We start on the left when we buy inventory. The top path tracks the asset. It sits in inventory, measured by DIO, until we sell the product. Then it becomes a receivable, measured by DSO, until cash is collected. The bottom dotted path shows our liability. We bought the inventory, but we delay paying for it, measured by DPO, until we finally pay the supplier. The difference between the top timeline of getting paid and the bottom timeline of paying out is our CCC KPI. It perfectly illustrates how operational timing directly dictates Treasury liquidity. To wrap up, building a comprehensive Treasury scorecard requires a careful blend of financial, operational, and subjective KPIs. You must define your scope, align your metrics strictly with corporate business plans, and set rigid internal and external benchmarks. When executed correctly, this KPI framework transforms your Treasury department from a reactive processing desk into a proactive, strategic control tower that protects the enterprise and drives shareholder value. Remember, this is not a set-it-and-forget-it exercise. You must continuously backtest your strategies and refine your metrics as market conditions evolve. I hope this deep dive has equipped you to rethink how you measure success. Please invite your colleagues to like and subscribe to our channel. For those ready to truly master Treasury management, visit quicktechie.com for premium certification prep. We offer extensive Q&A banks, full ebooks, audiobooks, full-length training modules, and expert interview guides to accelerate your career. Thank you for watching. Our final diagram shows the continuous feedback loop of a world-class Treasury scorecard. You define your KPIs, set your benchmarks, and execute your operations. Then comes the critical step: measure and evaluate. The results feed into your scorecard review. If you meet the targets, strategic value is realized. Excellent work. But if you miss the targets, the loop forces you to refine your strategy and process, which takes you right back to redefining your KPIs. This cyclical, continuous improvement model guarantees that your Treasury function will constantly adapt, grow, and drive unparalleled value for your organization.